Well, hello everyone. Welcome to the CryptoTaxAudit Ask Me Anything session. My name is Clinton Donnelly, the founder of CryptoTaxAudit, and I have with me our Director of Crypto Analytics, Ben Weber.
Hi, everyone.
So I'm glad you joined us for this session. And before we get started, I wanted to have we've done statistical analysis, and we have found that of our clients, 85% of them are men. And this is true internationally as well. And tomorrow happens to be the International Day for Women. So I was wondering if you're listening into the chat live, if you could just go into the chat function, tell us what city you're coming in from, and just reach out to all the, give a shout out to all the crypto women, the Bitcoin babes, and the mothers of mime. And that'd be great to recognize them. Today we're going to talk about the safe harbor allocation plan. And to set the background, the IRS came out with new regulations in the summertime. They're official, and they involve changing the way cost bases are selected when you sell a cryptocurrency. It used to be there was a lot more latitude. Now it's limited to a new method, a fixed method called FIFO, first in, first out, and it has to be done by wallet rather than a universal approach, which is the method that almost all the online gain calculation services have used. They all use a universal method. So in effect, all the prior gain calculations are no longer valid under the new rules. So in order to facilitate this transition, the IRS came out with a revenue procedure. They call it a transition plan, where you can map your cost basis as of the end of last year to the coins that you had at the end of last year, your inventory of coins, and create what we call an allocation map. It's basically a spreadsheet that now becomes the new baseline for your cost basis for all sales going forward 2025 and onward. So we're going to talk about how that works. If you are listening to this, you probably signed up for our safe harbor allocation plan, which is a requirement by the IRS to participate in this. Secondly, you probably did a physical snapshot of your inventory of coins at the end of the year. And Ben's going to talk about where we go from here. And I want to let you know that this is, we have a lot of time on your schedule to do these mappings. Really, you have until after you've done your gain calculation for last year. At that point in time, then we can do the allocation mapping. So it can be any time in the latter part of the year, but everybody's very interested in how that works, and we wanted to get that message out to you. So that's kind of a backdrop of what's going on. So I'd like to turn it over to Ben, who's going to explain how to take your physical inventory and how to get a closing position and create an allocation plan. So take it away, Ben.
Thanks, Clinton. I just have a few slides that I want to show to kind of help illustrate this. First, what is this allocation? As Clinton already mentioned, it maps the cost basis that's reconciled on your books as of 12/31/2024 to your actual inventory on 12/31/2024. Now, why does this need to be done? Because in the past, a lot of gain calculation softwares were using the universal method for tracking cost basis. And this, did not matter. It didn't matter if where your tokens were actually sitting for the purposes of tracking cost basis and calculating the gains. With the by wallet and by account method of tracking cost basis, this is now important. We have to transition you to the new methods according to the global allocation plan that you adopted. So in order to do that, you first need to reconcile your transactions all the way through the end of 2024. So as of December 31st, 2024, you'll have a list of all of your assets, when they were purchased, their cost basis, and this will be used to do the allocation. I have an example of the closing position report on the next slide. So as you can see here, This report shows the assets that you have, the amount, the purchase dates. It might even show where these assets were acquired, the original source where they were purchased, the purchase price, and the cost basis. So this is an example of a closing position report. The one thing that this report is missing is where your tokens are actually sitting. And that's what the allocation is going to do. So we go to the next slide, please. So this allocation, so why is this necessary? So this is the final step to comply with the safe harbor revenue procedure. This is really the final step, and this transitions you to the new IRS regulations so that you remain compliant. And this is really important to do. Now, when does this need to be done by? Before you file your 2025 tax return. So that would be in October 15th, 2026. But it really needs to be done before you reconcile your 2025 transactions. So the first thing you do is reconcile your 2024 transactions, get that closing position report, do the allocation before you reconcile your 2025 transactions. And you're going to reconcile your 2025 transactions, report that on your 2025 tax return in year 2026, and you have until October 15th. So you have that extended due date. So what does this report look like? I'm going to go to the next slide. This report looks really close to the closing position report. It shows your assets, the amount that you hold, the purchase dates, the wallet that it is held in, the purchase price, and the cost basis. So this is going to match your inventory snapshots that you took on December 31st, 2024. So it should show in each wallet on this report, the amounts of tokens that you have should match that inventory report. Now, this report is really nice because it gives you a starting point for reconciling your 2025 transactions. And with this report, you could upload it into any tax software. You could give this to any accountant, and they have a starting point. So you're not really tied down with this report. You can start, if you've really condensed your crypto situation and consolidated and made it simpler, and you're just on one exchange or two exchanges, you could use this report to start tracking your own crypto transactions and reporting your own gains. Or you could give it to an accountant and they can use this. So the next step, I'm going to show you an example of how we allocate from the closing position report, allocate and map the cost basis to your actual inventory. So on the next slide, I'll show this. Let's see. There we go. Oop. So on this slide right here, we have 3 tables. In the first table, in the left-hand side at the top, it's the closing position report. This is the report that I showed you previously, a similar one. In this example, the closing position report shows holdings of Cardano. And you'll notice that the holdings are ordered by the Cardano tokens that are acquired first to the ones that are most recently acquired. This is going to be important if you're using our global allocation plan, which allocates assets acquired first to unhosted wallets first. So the next table we have is the inventory snapshot. This would be the snapshot that you took on December 31st, 2024 of each wallet and account. So this it's just a table reflecting those balances on each wallet and each account. So here we can see that there's the ledger holds 70,000 Cardano tokens, Trezor holds 35, and Coinbase holds 15,000, all for a total of 120,000 Cardano tokens, which matches the Cardano tokens on the closing position report. So now that we have these two data points in front of us, we can actually do the allocation according to the global allocation plan. In this case, we're going to allocate assets acquired first to the unhosted wallets and then to the hosted wallets. Unhosted wallets are like your Ledger or Trezor or MetaMask. These are self-custody wallets. The hosted wallets are like our centralized exchanges like Coinbase or Kraken. Now I'm going to use a term called a tax lot. This means that a tax lot is an amount of an asset purchased on a certain date for a certain amount. So to give you an example, the first tax lot is highlighted in blue on the closing position report. 75,000 Cardano purchased in 2021 for $111,000. We are going to allocate that to these tax lots to the actual holdings on December 31st, 2024. So let's start with the first tax lot highlighted in blue. We need to allocate 70,000 Cardano tokens to the ledger first. So we allocate 70,000 of that 75,000 or 75,000 ADA tax lot to ledger, and we can see that the purchase date is May 6, 2021, and the purchase price is at $1.48. So the cost basis there is $103,600. And that's 70,000 tokens, which matches the ledger snapshot. Then we start allocating tax lots to Trezor. So 5,000 Cardano tokens of the first tax lot highlighted in blue will then be allocated to Trezor. You can see that the purchase price transfers over, the purchase date, and the final cost basis is $7,400. Now there's 35,000 tokens in Trezor, so we still have to allocate more tax lots to this wallet. So then the next tax lot is highlighted in yellow. 10,000 Cardano tokens purchased in 2022 for $6,426. That gets allocated to Trezor. The third tax lot, highlighted in purple, is then allocated to Trezor as well. And we can see that it transfers over. Then finally, the third tax lot needs to be split between Trezor and Coinbase. So 15,000 is allocated to Trezor, and this is the final tax lot highlighted in green. And 15,000 is transferred to Coinbase. So we can see in Trezor that there's 35,000 Cardano tokens with 4 different tax lots highlighted in blue, yellow, purple, and green. And then in Coinbase, we have the last tax lot highlighted in green, and that's 15,000 Cardano tokens. So if you notice in the first tax lot highlighted in blue, we have to split that amount when we allocate it. We also have to split the amount that's allocated in the fourth tax lot highlighted in green. So the green tax lot needs to be split between Trezor and Coinbase. As you can see, the Ledger and Trezor were allocated tax lots first, and Coinbase allocated tax lots last. And that's following the global allocation plan of allocating the assets acquired first to the unhosted wallets, and the most recently acquired tax lots to the hosted wallets. So the allocation report again looks very similar to the closing position report. We have the same amount of Cardano tokens, 120,000, and the same cost basis, 140,752. So it should really match the closing position report. And the difference will be it actually shows where those tax lots are sitting as of December 31st, 2024. So I think with that, we're going to open this up. Clinton, do you have any questions about this report here?
Yes, no, I think the report is really good. So the snapshot inventory everybody took at the end of last year, the closing position report you're going to get from whatever crypto tax calculation software you used, and you're going to get the mapping. Now, I will mention that a lot of the crypto calculation softwares, because of weaknesses in the data, you may end up with perhaps more or less of a certain coin than you actually have in physical inventory. And you'll just have to compensate accordingly. So if you had a situation where the closing position report said you had 121,000 ADA, but your real inventory is only 120, when there was just a mistake and you have 1,000 extra, and you'll just need to discard 1,000 from the cost basis report. Conversely, if you end up that you have less inventory, your inventory says 120,000, but your closing position report said 119,000, then you'll have to think back and come up with an estimated price and cost basis and date for that extra 1,000 coins. This is going to happen, and you probably know better than anyone else what date you probably bought or sold those coins, so you could work it out. It's just going to be, don't be disturbed that it doesn't map out quite correctly, and it's a weakness in the way these online software systems process data. So just be aware of that. And I think it might be good to take this moment to remind people, why are we doing this? And the reason is because of the new regulations. If you don't do a safe harbor allocation plan, including this mapping, then the IRS will use FIFO by wallet retroactively on all your prior tax years. And we've actually been dealing in appeals on a tax case, and they actually are trying to do this, retroactively apply the FIFO rules. So you really want to protect yourself from the past calculations by having the allocation plan. Plus, the allocation plan gives you a fresh start on your cost basis for going forward on your calculation, because as I was alluding to before, there's a lot of errors that creep in. So and that new cost basis, the IRS has said, if you do this safe harbor method, then they're not going to investigate it too hard. Pretty much our belief is, if we can produce the inventory records to prove the inventory, they're pretty much going to take your word for it that it's correct. So it's a great way to have a fresh start, to not have to deal with all those missing exchanges that you can't get the records from, the FTXs, the Cryptopias, and the Celsiuses. This is a great fresh start, and that's why you want to do this. And that's why it's worth spending some time and money at it. If you get the gain calculation done, this allocation mapping done right, then you're going to save yourself a lot of money in taxes. If you don't, the way FIFO works, you'll end up paying more in taxes up front. So also, I should mention that there's more people that have signed up for the safe harbor allocation plan than we can really do the work ourselves. So most people are going to have to do the allocation mapping manually, as Ben described it, which was just a snapshot. So, but people have more complex situations, or for whom this work is overwhelming. We'll have a offering, and we've done some analysis, and we're going to be charging $1,200 to do the allocation mapping. Maybe a few $100s more if you're particularly complex. But I would recommend to you to try to do it yourself. You know, if you have difficulty, then you can reach out to us and we can do the calculation for you for a fee. But we do think that most people with simpler trading situations should be able to do it themselves. If you're a frequent trader and still have a lot of coins, then this might be more frustrating. So with that, Ben, I think we have some questions that people have sent us. Let's go to it.
I thought everyone was in the clear for 2024. The safe harbor was delayed. No. So this was some misinformation that was going around. The IRS did come out with a notice at the end of December of 2024, but this was related and affects mostly centralized exchanges and what their reporting requirements are. So this had nothing to do with the safe harbor. The safe harbor is still in effect, and you should have adopted a plan and taken snapshots for the safe harbor. Besides taking screenshots and documenting our crypto wallets on December 31st, 2024, and sign the safe harbor agreement, was there anything else we needed to do for the safe harbor plan? So those were the main points that you had to do before the end of the year, the main action items. Now it's reconcile your 2024 transactions, do the allocation, which you have until you file your 2025 tax return in year 2026. So there's plenty of time. There's no reason to panic. There's time to sort through these issues, to reconcile your 2024 transactions. If you need help, we're here to help do that. If I didn't sign before the deadline, will it be acceptable to print it out now with a handwritten date before the deadline? So I think, yep, go ahead.
Yeah, I would say if you haven't signed it, then definitely go to our website, CryptoTaxAudit.com/1099. And we have a safe harbor plan there. You can electronically sign it and file it. I think it's still available. And even though it's dated late, if you are audited, we'll have to make an argument that though it's dated late, we can effectively reconstruct what your asset positions were at the end of the year of 2024, and just show that. And I think we just have to argue it in court. But it's better to have something like that allow us to argue it before the auditors and before the court than to not have anything at all. So, and if you haven't taken your snapshot of your inventory on that date, what we can do is take a snapshot today of all the wallets online and offline that you have, and then along with your transaction history from year to date, we can go backwards and reconstruct what your history was in order to come up with an allocation plan to get you going. So, but definitely do those two things if you haven't done it yet. We think there's a valid case for arguing for it with the courts, but of course you're on the mercy of the courts if they want to accept it or not.
How does the global allocation work for someone who is doing solo staking? So I'm assuming solo staking is just staking on your wallet. The global allocation doesn't affect staking. It's just a way to transition taxpayers to the new IRS regulations. That's all it's determining. It's not determining anything else. It's just saying in the past, taxpayers were using methods that are no longer acceptable by the IRS. In order to transition from those methods to the new ones, you have to do some accounting. That's really all it is. It's adopting a plan of how to do the accounting and then doing the accounting. And the accounting is this allocation. Is the safe harbor and cost basis allocation good for all tax years going forward? This is, again, it's just the transitioning you from the old methods to the new IRS methods. It's also protecting you from the IRS going after you, and applying FIFO by account in the prior years if you use alternative methods. So this is a protection from your past. And moving forward, you'll be using the new IRS methods, which is the FIFO by account. I took the snapshots of my wallets on December 31st, 2024. Even though I just buy and hold, do I still need to report my wallets on my tax returns? So there's no requirement to report your wallets on your tax returns. You report taxable events. So you're reporting sales, and you're gonna report, the gain or loss from that sale or disposal. And then you're also gonna be reporting crypto income like mining, staking, yield farming, other crypto rewards. The website says that the allocation service won't start until after the April tax deadline. Is that because the new IRS rules start then? I thought it was for 2024 taxes, or is it for 2025 and beyond? So it's a two-part question. There's not a huge rush right now to do the allocation, as it doesn't need to be done until you file your 2025 tax return, which you have until October 15th, 2026. We're offering the service after April 15th because right now it's tax season, and we have tax returns that we're filing, so we won't have capacity for this service until after April 15th. I understand FIFO is per exchange. If I bought on Uphold 2 years ago and moved it to a Ledger cold wallet, is it best to transfer it back to Uphold before selling to keep FIFO tracking? It doesn't matter, really. Uphold forgot about when you transfer from an exchange, that exchange immediately forgets the cost basis of that asset. So if you transfer it back to the centralized exchange like Uphold, you will have to tell Uphold what the cost basis of that asset is. Every brokerage allows me to choose between FIFO, LIFO, and HIFO. Are you saying that these brokerages are non-compliant and I have to select FIFO? So to clarify, we've been saying FIFO because FIFO is the default. In order to use what's called specific identification, which is FIFO, LIFO, or HIFO, LIFO or HIFO, that's just another term for specific identification. It's still allowed, but you have to identify the unit or the cost basis of the assets that you're going to sell or transfer before you sell or transfer them in order to do specific identification. And you have to save that to your books and records. In order to do that, you have to have adequate books and records. You have to have up-to-date information on all your cost basis in order to specifically identify which assets you're going to transfer or sell. For exchanges, starting this year for tax year 2025, they are required to report the proceeds of your sales to the IRS. Starting for tax year 2026, for year 2027, when you're reporting your 2026 income, these exchanges are required to also report the cost basis. Without going into too much details, the exchanges are allowing people to choose FIFO, LIFO, or HIFO as a way of complying with the specific identification. They are going to identify the assets for you before they sell the assets, so you don't have to. So these exchanges are being compliant by saying they're going to specifically identify for you in a specific order that you're requesting. When it comes to going back to your wallets and decentralized exchanges, that requirement is on you to specifically identify the assets. Now, a lot of people, even myself included, I'm not up to date, on my cost basis when I make a sale. Usually, if you're selling every day or you're trading, doing a lot on decentralized exchanges, it's going to be very difficult to know what your cost basis is on an up to date schedule.
Can I add a couple words on that, Ben?
Of course.
Yeah, the law does allow you to use specific identification, but you're going to have to track every single cost basis on exchange and on an exchange and also on your unhosted wallets. And if you fail to adequately account for all your lots and all your coins, then the IRS has the latitude to totally disregard all specific identification statements that you provide. We personally feel that the only people that could really effectively manually manage their lot basis in order to specify specific identification would be people who have very limited amount of trading activity and are very anal in keeping track of those records. So we just think it's fraught with an opportunity to fail. Secondly, the standing orders that the person asking the question, the exchange can have a standing order of FIFO, HIFO, or LIFO in terms of which one it sells. There's a weakness there in that if you've moved a coin to a private wallet and then you brought it back onto the exchange has no idea what the cost basis is. So it has to make a determination without reference to really knowing what your cost base is for those coins. The third problem that enters in is while you can specify HIFO, LIFO, or FIFO as a standing order at an exchange, you're going to have difficulty when you're trying to do your gain calculation on the following year, because the tools that you use like Coinly and CoinLedger and CoinTracking, they are going to assume a single method for all coins transferred. So you're creating a complexity there that you're going to have to back out and correct in future years. Furthermore, in future years, the IRS will start, or the exchanges will start to issue 1099 transactions, which you're going to have to back those out of your gain calculation. So it gets much more complicated in the future, especially if you're trying to do specific identification. And we think it's somewhat perilous at the same time. So that's why our position, our default position is that everybody should just use FIFO. Keep your life simple.
If I don't have if I don't have records of all of my transactions before December 31st, 2024, what should I do? This is a common area. You're not alone. I talk to people every day, and they're missing records here and there from this exchange and that exchange. You or your accountant will have to do their best to reconstruct the trades that happened. One way that an example is, a lot of people will use foreign exchanges like KuCoin or Mexi, and they just transfer tokens to the exchange. They do the trade, and then they transfer tokens out. So in that way, you can see, okay, I transferred tokens there. I traded it. Let's just say it's USDT. I withdrew ETH on the same day or a day later for a similar amount. We can reasonably assume that that's a trade. And so that's one way to reconstruct your data. How can the IRS or I obtain the cost basis for any coin if I can no longer sign on to one of the exchanges I used to purchase them some years ago? You'll have to use your best and most reasonable estimate on when you acquired those tokens. That's what we recommend. If you know when you deposited those tokens to your wallet, maybe it was a few years ago, you can say, okay, I purchased it around March of 2019, and that would be a reasonable estimate. I have a lot of crypto, yet know nothing or understand how to be and stay compliant. Where do I start? I think, the first, if you're feeling overwhelmed, the first thing is talk to somebody, you know, talk to an accountant who understands this, who's familiar with it, who's seen, you know, all the ugly out there, and can turn that into beauty. That's what I say. Um, get talk to somebody; they'll tell you where to start, what you need to do, um, and you'll be happy that you did that.
Well, I should also mention, Ben, that they can talk to us. We do consultations, and you can talk to a number of our staff, including myself. We do calls. You can go to CryptoTaxAudit.com/contacts, and you can see our staff. You can talk to me or one of my other staff about your situation. And I would say this, that if you have a lot of crypto, as you said, it's very important that you get the gain calculation right. Just because you use one of these online tools, and the tool comes back and says, well, I was talking to one client, he said, this tool said I made $150,000 in a particular year, and he said, there's no way I made $150,000. I asked him, what do you think you made? 90,000, he said. So I said, look, that's a $60,000 difference. Is that if you call us up, if we do the work for you, that you're going to save so much on taxes. I mean, the tax on that would be 20,000 more or less. For far less than that amount, we're going to do the gain calculation for you. You know it's going to be right, it's going to be correct, and you're probably going to save even more money. So there's a certain point where you really want to get having professional help is worth paying for. So don't be penny wise and pound foolish on doing your gain calculation. Most of our clients that come back year after year know that they don't want to handle the hassle of a gain calculation because we do the full calculation for them. Ben's team does. And they know that it's done right because we actually defend numbers against the IRS. And we have successfully defeated every time the IRS has done a gain calculation on our clients. Ben's team has successfully destroyed their calculation numbers so that they don't reign. So it's very key to get it done right. And we are the professionals. That's why we're the number one firm in the country that does full service gain calculation and return prep. And we defend people during the audits as well. Thanks, Ben.
Can I still match, buy, sell as I see fit to minimize profit and maximize rollover loss? Are there restrictions on rollover amounts? Yeah, there's still ways that you can try to, minimize your profit. One way, if you're interested in that, that might be beyond this conversation. Give us a call and we can tell you, how you can do that. There might be some strategies with separating your tax lots into different wallets, so you know which ones are, high cost basis and long term. So there's some different strategies there. Will the Coinly tax statement do this for us? So for the allocation, what you need for the allocation is a closing position report and your inventory snapshots, and then your global allocation plan on how you're going to map your tax lots that are on your books, so your cost basis for your assets, to your actual inventory. So, if Coinly provides a closing position report, then you'll be able to do that.
Well, to be clear, Ben, the tax statement that you get out of Coinly or any of the other services is not a closing position report. It's a list
Correct.
of the sales that you made the prior year. All right. So what you're trying to do is find out from Coinly, what do you think I still have? That's what a closing position report is. What do you think I still have? When do you think I bought it? And how much of that did I have? And some services have a standard way of generating a closing position report, but you may just have to reach out to Coinly on their chat function or email and ask them, how can I get a closing position report? Because I don't think Coinly in particular does not offer a easily generated closing position report. So you'll need to go through chat and get the instructions from them. Maybe they have a blog posting on how to do it, not sure. But whatever service you use, You might want to just Google to see if they have a closing position report or closing lot report, something along these lines that can get generated for you. You'll have to get that in order to use the data to do the allocation mapping.
And just to say there with this closing position report, I think it's such a important report because year after year you have a baseline of what your cost basis and assets are that you don't need to go back through all your entire transaction history. You have it right there in one report. And if I'm being honest, I don't when companies come to me to test out their software, the first thing I ask is, do you have a closing position report? And if they don't, then I'm just not interested. So that's how important that report is to me, and my views on that. So what if I transferred most of my crypto to 2 LLCs this year? So this allocation and global safe harbor still applies even if you have LLCs. It's even more important because you have to track all of the contributions that you made to the LLC. If you're making contributions in crypto, you have to know what the cost basis is to those cryptocurrencies so that the LLC can do the correct accounting. If you only use one wallet, does this even matter? The allocation, not so much, but knowing your cost basis, absolutely. If you just have one wallet, there's not really an allocation because everything on the closing position report that I showed you would just be going to that one wallet. But you still need to know your cost basis. The safe harbor plan, I think, is still very vital to have to fall under the safe harbor and protect you from the IRS retroactively applying FIFO by account to your previous years. So yes, this is still very important. I have not been tracking my cost basis and purchase dates and have them all in wallets. What would you do? I suggest to figure this out when I sell. I heard the accounting software does not always show. So yes, the thing about accounting softwares is you still need a person to do the work and who understands how to do it. So if you're in this situation, I wouldn't wait until you're going to sell. I would get this taken care of now. The more time you put this off, the harder it will be to figure out your cost basis in the future. Just as time goes on, going back further in history, it becomes more difficult to recreate and reconcile transactions going back several years. So I would recommend doing this at least once a year, minimum. And just to say, if you don't know where to start, give us a call. We'll be able to help you, walk you through the steps. My team, we do all the work. You just give us the data, and we do everything. You're not gonna your plate. You will be able to do the things that you enjoy and love, and we'll take care of you. What if we use FIFO reporting anyways, so we don't need protection from safe harbor? My question to this would be, was FIFO by account used or FIFO universal? So if you use FIFO by account, there's really no safe harbor because you were using the IRS prescribed methods from the start. But what you still want is a closing position report to know what your assets are. But if you were using the universal method of accounting, then this definitely applies to you. The issue with the universal method is we don't know where your tax lots, where the cost basis is sitting, what wallets they're sitting in. So we still need to allocate the cost basis to your actual inventory.
I should mention, Ben, that there's about 8 gain calculation online services, softwares, if you will, and of the 8 of them, as of the end of last year, only 4 of them offered by wallet calculations. So that means universal was the default. So even if this person did a FIFO setting, it may be, depending upon the service they use, still a FIFO universal. The switch between universal and by wallet can create a significant swing in your tax situation. It's not. It sounds like 2 words, but it can be very significant. We've seen very big swings, and when you go to the services, I believe that offered per wallet tracking, and they use different words. One of them is per wallet, by wallet, multi depot would be a terminology. CoinTracking, Coinly, CoinTracker, and I think CryptoTaxAudit were the only services that offered by wallet options. And typically those were not the default. So almost everybody defaulted to universal calculation. So yes, even if you did FIFO, you still would highly recommend that you do this whole safe harbor allocation method.
I'd also like to add there that CoinTracking.info offers the closing position report that is necessary for this allocation. They also do have a feature that allows you to do the allocation, so you're not doing it in Excel. So they do have that. That's very nice. I like CoinTracking. Where do you submit these reports? So these allocation reports will not be submitted. They will be kept for your books and records, and you will need them to reconcile the 2025 transactions, report your gains on the 2025 tax return, and if you are audited, you will need this report to substantiate your gains in 2025 and moving into future years. Would you explain why the tax lots need to be split? That is what you refer to as mapping. Yes, absolutely. This is a good question. And could we bring the table back up? I'm going to refer to that as I answer this question. So why do the tax lots need to be split? So if we look at just the blue tax lot, the 75,000 ADA tokens on the 2024 closing position report on the left, this tax lot has 75,000 ADA tokens. And we need to allocate it between the ledger and the trezor. And because ledger only has 70,000 Cardano tokens, we need to allocate 70,000 of the blue tax lot to ledger and 5,000 to trezor. So we're essentially splitting that line into 2 lines so that we can show that ledger has part of that tax lot and trezor has the other part. And what helps us get to the original cost basis is the original purchase price of $1.48. And that will give us the cost basis of $103,600. So that's why we're splitting it, because as you know, with crypto, nothing is just straightforward. Things are going to need, the tax lots are going to need to be split up to be allocated to the various wallets. Great question, by the way. What if someone traded DeFi in and out of ETH with other altcoins? Does every calculation of ETH have to be calculated, or can it be an initial buy of ETH from a centralized exchange, and what is now? So starting for January 1st, 2025, everything will be by account. So if you buy an Ethereum token on Coinbase, transfer that to your DeFi wallet. Let's say 1 ETH for $10. We are now tracking that 1 Ethereum token purchased, in 2025 January 2025 for $10 is going to your DeFi wallet. So then that Ethereum token is traded for, an altcoin on Uniswap. So we're actually tracking that Ethereum token for $10 being traded. Now just add hundreds or thousands of buys and sells with, just even, 3 or 4 different wallets and exchanges. And you can see how this is going to be a little bit more complicated, well, a lot more complicated than the past. In the past, the universal method said, everything is one big pot or one big account. It doesn't matter where the tokens are actually sitting when you sell them. You can take the cost basis from anywhere. If I don't sell as fiat, but I convert to another American crypto coin, do I need to pay for that taxable event? As of now, all crypto to crypto trades are taxable transactions where you need to calculate the gain or loss, taking your cost basis and the value of the token that you're receiving, and that will get you the gain or loss. So all crypto to crypto trades are taxable, and there you may need to pay taxes on the gains. Where's the line for your services and how do I get in? I think we can drop a link in the chat. There we go. So you can go to CryptoTaxAudit.com and schedule a consultation with one of our team members. How does one tell an exchange what the basis to their cryptocurrencies are or is? I don't think there's like a conformity across the exchanges in the US. If I'm speaking from personal experience on Coinbase, I believe they ask you for the cost basis when you transfer it in. So when you transfer it in, the exchange should be asking you what the cost basis and purchase dates are to that token. So we have until October 15th, 2026 to complete the safe harbor. So this is to complete the allocation. You have until October 15th to complete it, but you probably need to do it before then because you need to reconcile your 2025 tax transactions and then file your tax return. So the tax return is due October 15th, 2026. So you'll want to do the allocation before then, so you give yourself enough time to reconcile the 2025 transactions and file the 2025 tax return.
And just to be clear, October 15th deadline is only if you file an extension, which has to be filed by April 15th. And you can do that with your tax software, your accountant, you get an extension filed. Then you get an extra 6 months to file the paperwork, although the amount of taxes you owe is still due on April 15th. So that's where the October date's coming in from, just so everybody realizes it's an extension. It's an extension date.
Yep. And again, just to emphasize, an extension to file, not an extension to pay. So if you may have to make an estimated tax payment if you are extending. Does this apply to NFTs as well? NFTs are non-fungible tokens, and in most cases, you can always go back, and if you purchase these on the blockchain, you can go back and find how much they were purchased for. There's only one NFT, so there's really no allocation for NFTs. The allocations come in for the fungible tokens like Bitcoin, Ethereum. So for NFTs, you can always figure out how much you acquired it for. It's one of a kind. There's no dispute on what the cost basis to that is. So, if you're concerned if this applies to NFTs, it's still good to have great records for your NFTs. You can include it in the allocation, just so you have everything, in order, and you know where everything's sitting and the cost basis for all your assets are. But it will, if you didn't take snapshots of your NFTs, it's not the end of the world. I bought crypto before 2025 on cold wallets, PayPal, and Fidelity. I plan to HODL for life and pass on to my kids. How does complying with a safe harbor plan affect me if I never sell or I've never sold? So in that case, if you've never sold, uh, there really is no safe harbor or allocation. But if you're going to pass these on to your kids, I highly recommend that you start tracking the cost basis to these. Even if you don't have a tax reporting obligation, if you get 10 years down the line and you haven't kept track of your cost basis for these assets, it's going to be very difficult. And if you plan to sell in the future, maybe you just, something comes up and you need to sell, it's important to have that cost basis. I did the screenshot allocation before December, but I moved all of my crypto to hard wallets a few weeks ago. Could this create a potential problem? Nope. This should be fine. Took the if you took the snapshots and you didn't make any transfers or transactions between the time of the snapshots and the end of the year, December 31st, there's no effect. The snapshots will be accurate. But if you did the snapshots and you did some transactions before the end of the year, there might be some issues with figuring out what your actual year-end holdings were on December 31st. If this is the case, give us a call. We might be able to reconstruct what your holdings were on December 31st, 2024. We have extensive experience reconciling these blockchain transactions. I'm sure it won't be a problem. If I move coins between wallets to sell non-custodial to custodial, won't that mess up the allocation plan by mixing coins with different cost bases? The allocation is a one-time thing for transferring you from the old methods to the new required IRS methods. So once you do the allocation, you start moving things around, you're on the by account method for tracking your cost basis. So there's, the allocation is a one-time thing. Moving things around now won't affect the allocation. Do you guys recommend to make first the reconciliation and safe harbor before creating an LLC? I'm assuming this is to set up an LLC and contribute to hold your cryptocurrencies. The reconciliation needs to be done no matter what. It should be done before, whether you're going to contribute it into an LLC or not. If I purchased all my cryptos years ago in 2021, 2022 from Uphold and Coinbase in many transactions, how can I find my cost basis for all of these transactions? You'll have to download the transaction histories from Uphold and Coinbase, and you'll need to use a crypto tax software or go to an accountant like us who specializes in these crypto reconciliations and tracking cost basis, and we'll calculate the cost basis for you. But again, you just need the transaction histories from both of those exchanges, and you'll be able to do it. How many times per year do taxpayers have a duty to check for brand new requirements that are due almost immediately? So with as a taxpayer, it is your obligation to stay up to date on uh, tax laws and make sure that you are compliant. Um, the new IRS regulations for the safe harbor was announced in July of 2024, which it still that's 6 months, not a whole lot of time to understand something that's very confusing. But unfortunately, that's what occurred. We started, announcing this safe harbor plan in September of 2024 to make sure that people were aware of it and they could prepare. So it's hard to stay up to date on these things, but if you follow our Twitter, we're usually trying to be the first to let people know what they need to know to stay compliant. Should we consider consolidating in our cold wallets? For tax purposes, I don't see the point in doing this. If one thing with taxes is you never want in cryptos, you shouldn't always do something for taxes that don't make sense for your own security and holdings. You want to do the best practices in cryptos. Make sure you're safe. Make sure your cryptos are stored properly. And doing what you feel comfortable with. Ultimately, by consolidating into cold wallets, that's going to be a personal opinion, what you feel comfortable with. And you should do what you feel right for your wealth. If you bought and sold crypto since December 31st, 2024 snapshot, will this mess things up at all? Absolutely not. You're fine. The allocation is just going to allocate all the assets that you purchased before 2025. And then you'll be able to reconcile 2025 with that allocation. Purchasing in 2025 right now, you can do it even if you haven't done the allocation. So if keep on buying. What is the difference between guard dog and tax shield? Clinton, do you want to help with this one?
Yeah. Well, one of them I came up with the name. The other one my administrator did. I think she did a better job. Tax Shield, Guard Dog is our full service of three different offerings for different levels of coverage and protection for people in terms of audits. There's a basic fee service called Represent, where we monitor your IRS accounts on a weekly basis. We send you a monthly status report on your IRS account, kind of like a credit score. And if we also can call the IRS on your behalf to discuss any problems that you're having with the IRS. Tax Shield is basically a packaged offering of that in terms of an annual payment plan. Then we have two additional IRS Guard Dog offerings which I would say add an insurance element to it, where we cover the costs of defending you in an audit and or a tax court case. And depending upon what level you have, that's a monthly payment at different amounts. And quite frankly, the full service is our most popular plan particularly for larger traders who have a very high risk of being audited. I might make a comment here just at this point about the IRS and about what the Trump administration is doing. First of all, they're sending out a lot of messages about how, they're going to do away with the IRS and do away with crypto taxes or only tax American coins. They're saying things. However, they can't change the law. All these things require Congress to approve it. And as you know, Congress is it's very difficult to get anything approved in Congress. The Republicans do not have a substantial majority to make their will be carried. So I think you should assume that you're going to have to pay taxes for 2024. Rarely is this stuff retroactive. I don't see any bill coming forward to get rid of the IRS until next year at the earliest. I think the Trump administration is going to have to prove that through tariffs and reductions of waste and headcount reductions, that they can balance the budget and reduce the need for revenue before they can actually get rid of the IRS. I think that's going to be a tough sell. I think it's going to be a sell for next year, and it may very well be a politic issue, so, an issue that politicians are going to debate all the way through next year. It might not even be until 27 that we get action on that. So you should act accordingly, assume that nothing's happening that way. And you should, I mean, they're talking about things like only buying American coins and no taxes on American coins. Again, requires congressional approval. You're not going to see that till 26 or 27. There's also talk of headcount reductions with the IRS, and they've had some headcount reduction. They got rid of 7,000 of 100,000 employees, and the 7,000 were probationary employees, juniors, if you will. So they got rid of those. And if they have an additional headcount reduction, it's my opinion that the IRS would still retain its audit and enforcement staff, because that's basically what the IRS is about. There's a whole bunch of administrative staff that they can get rid of. And the IRS ultimately is about how much money did you bring in, and that's where auditing and enforcement come to bear. What I would see happening is that auditors are on a quota basis. So, and I've had auditors tell me this, they're in a department and every month they get ranked who brought in the most amount. So it's a monthly ranking. And if there's fewer auditors, they're going to focus on the bigger cases. So they're going to stop looking at the low cases where people didn't allegedly paid no taxes or had shady refunds, whatever. I think they're going to go for the big fish and focus all their energies on the big fish because they have limited staff. So I think you should take that in mind as you think about it. We personally believe that everybody should become at least a tax shield member. It's a price of $495. You can see it on our website. $495 for the year, and we monitor the IRS for you. Hey, look, the IRS is watching you. This is the only tool out there that allows you to watch the IRS. There's nobody else offering a tool like this, and I think it's invaluable. We can see months in advance when the IRS has flagged one of your tax returns for an audit, and several times we've been able to keep the audit from happening by taking swift action. So we are the experts in defending. I don't think anyone's defended as many crypto audits as we have, and taken cases to the tax court and being highly victorious there. So I think everybody should at least be a tax shield member just to protect yourself and your wealth. Little pitch there. Thank you for the diversion. I think we have one more question.
I think that was it.
All right, we smashed it. Thank you very much, everyone. Thank you, Ben, for an amazing presentation, such clarity. And again, we'll have more AMAs throughout the year, and this will be up on our YouTube channel if you want to listen to it again. And if you feel that you need help doing the work, you can always call us. I told you our price for doing the work is roughly $1,200, maybe a few hundred more if you're a particularly complex account. But we think that most people should be able to do this themselves, depending upon the level of complexity that you have. So I wish you the very best. You're not alone. We're here to help you. Keep watching our channel on Crypto Tax Fixer or in Crypto Tax Audit. Like it. Please like this video if you watched it, and follow and subscribe. Thank you very much for your time. Thank you, Ben, for everything.
Thank you, Clinton. Thank you, everyone.
Bye-bye.